Today, when we think of stock exchanges, we think of the bulls and the bears on Wall Street, throwing money at thousands of the world's biggest companies, hoping to see their initial investments skyrocket, all the while dreaming of all the things that money could buy them. But trace back the roots of where the stock market got its origins, and you find something different. In fact, you find just one company, and the very first stock exchange that was built around it, making it one of the most powerful companies in history, with a complete monopoly on its industry, its own personal army, and enough money to exert its power across the globe. Not only was the first stock exchange built around the Dutch East India Company, but it would also help usher in an age of economic prosperity the country had never seen before, laying the groundwork for a huge part of the global financial system we have today. This is Learn Something New. While the Dutch East India Company would revolutionize what it meant to be a business, it actually didn't start as just any business. You see, the Dutch weren't doing well at all at the end of the 1500s. Throughout the century, they had tried to get into the immensely popular spice trade that was taking over Europe, but was largely dominated by Portugal. The Netherlands, wanting to expand their own influence and economic opportunities, needed to try and get a piece of the spice pie. But after a war with Spain ended in political marriage that left the Netherlands under Spanish control, as well as Portugal, Spain, and Italy working together to bar the Dutch from intercontinental spice trading, the Dutch knew something drastic needed to be done. Their merchants ventured out into international trade waters hoping for riches, and while some were successful bringing back spices, many were lost, and the losses became a costly weight to the merchants trying to justify their trips. Instead of having all the merchants try and manage the risk of these extraordinarily dangerous ventures on their own, the government allowed a monopoly to form, combining the top trade companies into a United East Indies Company, or what we now refer to as the Dutch East Indies Company, coming together in 1602. Combining their resources, workforces, and ships would allow the company to better handle the risk that trade posed and give them a better chance at success. But the powers bestowed upon them didn't stop there. They were given semi-governmental powers to operate independently while abroad, including the ability to begin wars, maintain armies, prosecute convicts, negotiate treaties, and establish colonies. And to be fair, the Dutch weren't alone. 2 years prior, the English East India Company was founded, which had also been given a monopoly on trade and some governmental abilities. But there was a key difference between the two that would set the Dutch apart in a huge way. A lot of these early trading companies typically saw many investors contribute a certain amount of capital for a set length of time, say 10 years. At the end of the 10 years, the trading company would be liquidated, with investors receiving their money back plus any profits. Often, the company would then be remade in close to its previous form, with a new round of funding, only to be liquidated again and again. The Dutch, on the other hand, did things differently that would go on to shape the world's financial markets, setting the foundation for stock exchanges we have today. Firstly, its charter enabled shares to be transferred between investors, and these began to be traded on a secondary market in Amsterdam, which up until that point had only dealt with commodities trading, effectively creating the world's first stock exchange, the Amsterdam Stock Exchange, around one company. Secondly, and with what caused the Amsterdam Stock Exchange to have its lasting power, in 1623 the directors of the company opted against liquidating the company at the end of its charter. This was highly controversial at the time, but had the effect of turning shares in the company from a fixed-term investment into a perpetual investment. This is how shares in companies work today. You buy a share in a company in perpetuity. What this meant is that in order to get back their original investment, investors in the Dutch East India Company had to trade on the market. There was no liquidation event to hold out for. The incentive to hold the shares came in the form of dividends paid from the profits, which weren't always paid out in cash, sometimes in the form of goods like cloves, pepper, or nutmeg instead. This, along with the idea that the shares one held would eventually become worth more over time, further incentivized people to hang onto their shares. This proved to be hugely successful, and was eventually copied by the English East India Company in 1657. Over time, secondary trading became even more important, and with the Dutch East India Company becoming the world's most powerful company, the stock exchange in Amsterdam similarly became stronger. Similarly to today, buyers and sellers would gather together on a trading floor at the exchange in Amsterdam to trade shares for themselves or for their clients, usually wealthy merchants. with some getting 1,500% returns on their investment as firm trade routes were established. Some even made a living on speculating on the day-to-day price of shares in the Dutch East India Company, with trading clubs popping up all across the city where traders would look for any information that might gain them some insight into what the shares might do next. Derivatives would also emerge during this time period, including forward contracts and options, both still mainstays of modern financial markets. The Dutch East India Company established the Dutch colonial presence in places such as Indonesia and South Africa. It existed for almost 200 years and largely defined the Dutch Golden Age. Abel Tasman was in the service of the Dutch East India Company when he became the first European to discover New Zealand in 1642. And with its fixed and reliable capital base, the Dutch East India Company dominated trade between Europe and East Asia, eclipsing the hold that the Portuguese had on trade in the region in the preceding centuries. Through its trade in rare spices and control over vast territories, it grew into a behemoth in every sense of the word. More than a company, it was a centralized, quasi-governmental multinational conglomerate with its own military force. At its height, it owned 40 warships with 10,000 soldiers, along with 150 trading ships and 50,000 employees, monopolizing the trade of several commodities in the process. And it would be for this very reason that it all came crumbling down. Although it seemed like the Dutch East India Company was becoming too big to fail, that's exactly what it did. For starters, the company was finding it harder and harder to keep its territories that it had taken over. The suppressed population was needing a constant stream of more soldiers, as the company ruled over 1 million people in Indonesia and as far north as Japan. Its military went from a few hundred soldiers to thousands, causing massive costs to the company. There was also the problem of corruption. The majority of the high-ranking employees brought on in the final decades of the company were often soldiers who had grown wealthy through the trade, as well as many who were the product of nepotism. Not to mention, a growing company offsetting the cost of labor by giving low amounts of pay to its employees saw everyone, even senior executives, getting corrupt. One governor general working for the company in 1762 had a salary of 700 Dutch guilders a month, yet after a 6-year stint, brought home with him nearly 10 million guilders. The company's role as a monopoly began hurting them as well, as with the increased costs and the corruption, smugglers began undercutting their costs, upsetting their role as a monopoly for the Netherlands. Privateers thrived independently of the Dutch East India Company and began fulfilling the company's orders to the point where they couldn't keep up. And as conflict broke out in the Fourth Anglo-Dutch War, where the British sunk many Dutch ships and limited their ability to sail along trade routes, as well as the collapse of the spice market in favor of other commodities like sugar and cotton, the Dutch East India Company just couldn't keep its head above the water, declaring bankruptcy in 1799, just 3 years shy of 2 centuries in operation. When the Dutch East India Company closed, the Amsterdam Stock Exchange was greatly diminished, but not closed off, though it wouldn't have a great resurgence until the mid-1800s, when the Netherlands freed themselves from French rule. The Amsterdam Stock Exchange proved to be the driving force behind the restoration of the nation and recovery of the economy throughout the 19th and 20th centuries. And in 1997, the Amsterdam Stock Exchange merged with the European Options Exchange, and again in 2000 with the stock exchanges from Brussels and Paris, renaming itself as Euronext. Through its entire history, the Amsterdam Stock Exchange, as one of the oldest still functioning stock exchanges in the world, has guided the Netherlands to becoming one of the most stable and successful economies per capita to ever exist. Thank you for watching Learn Something New. If you enjoyed the video, please consider liking it below. Thanks again, and I'll see you in the next one.